Welcome to question 4 in the May-June 2024 paper. This is paper 2-1 short answer. Focus of this one is on assets. So the first focus is around Ahmed, and he owns a trading business. He prepares financial statements to the 31st of December every year, and he's got some unused office space. He's decided to use this to store inventory and rent the rest to Bilal. So Bilal's an important person for Ahmed. On the 1st of January, he started renting his office space. The annual renting charge is $4,800. That's important because that there is the expense that will close off to the income statement. During the year, Bilal made the following payments. So what we need to do is, on your one's a little bit funny, if you can just squash in the 2023, just at the top, just under date, but not on that first line. And what we're going to do is we're going to record the payments to start off with. So first payment happened on April 1. And when the payment happens, the credit is to rent received because it's an income account. So income account going up on here. And the debit was how he paid us. And that was money went into our bank account. And you do the same thing on the 30th of September. Money went into our bank account, so we're adding it to bank. All right, nice and easy to start with. So the total amount that went into our bank account, we'll add those two together. But what it also tells us is what the annual rent is. So we're going to close off to our income statement. The annual rent, which we got told was $4,800. And you'll see that that doesn't balance to $6,000. So what that means is that Bilal's actually paid for some of next year's account, the 2024 account, in advance. And so that's going to leave us with a balance, which will carry forward to the next year. You can calculate that out easily, 1,200, and we'll put 2024. The start of the year will be January 1. Which will bring down. Right, so these are the two payments that are made. That's the amount of the expense, so he's overpaid basically. That's an expense of next year, so we bring that into next year's income. The next one is the office equipment. A little bit tricky, we've got to do some calculations on this. Ahmed sold some office equipment for $1,350 to Rahat on credit. So we're not writing bank, we'll write Rahat there. The equipment was purchased for $3,200 on the 1st of January, and he charges depreciation at 25% per year using the reducing balance. He does not depreciate in the year of disposal. So what we've really got to do is we've got to calculate how much depreciation has been written off. So we've had it all of year 2021, all of year 2022, but really not 2023, does not charge in the year of disposal. So you've got to calculate what the depreciation we've written off is. So in the first year, 2021, so I'll get you to write this on the paper. I'll just highlight it so you do. In 2021, we're going to go 3,200 times 25%. And that means the depreciation for that year is, we do that in a calculator, but you should come up with $800. In 2022, it's reducing balance. So in 2022, the opening balance was 3,200 minus 800, which will give us 2,400 times 25%. And you can do that in your calculator as well. So 2,400 times 25%, or a quarter of 2,400. That gives us $600. So over its life, we'll just highlight the two key ones. We've got that one, and we've got that one. So we'll take that over to our disposal account. First thing you do in your disposal account, put the year. Well, is you put the asset. So the asset that was sold was office equipment. So it's going to be a credit to office equipment because it's going out of office equipment, and a debit to the disposal, 3rd of Jan. So we write the name of the equipment that was sold and what it was purchased for, all the costs. This disposal account needs to balance to 0, so both sides need a balance because it's not an expense or income, it's just a temporary account. Next thing we've got to write off, so we've written off the cost, now we've got to write off the provision for depreciation. And that one is equal to your 800 plus the 600. So that's what the balance of that account would have been. So we get rid of that because the asset's gone, so is the provision for depreciation on that asset. And then what we've got is we've got who we sold it to. Note that's not bank because it's not a cash sale. And we've got, or we'll be getting, from Rahat 1350. Now to balance this off, we write the bigger side. And the difference is 450. So we sold it for $450 less than our valuation. Our valuation was 3,200 minus 1,400. So if you like, 1,800. But we only sold it for 1,350. So we made a loss on sale. That loss on sale is an expense, which will go into the income statement. That's where we close it to anyway. Done. Yeah, that was a hard one. Well done. So the third part C, is to complete. We're building, complete the table by placing a tick. This is to building the new storage unit. Basically, we've got to do a capital revenue expenditure. I haven't put those numbers in. I'll just do that now. The benefit of the pause button. I hope you're using the pause button as well. And what we're going to do is put a tick. Now, a capital expenditure is a one-off that creates the asset. A revenue expense is one that's ongoing. So it doesn't create an asset, it's an ongoing expense. So you just got to place a tick in the right box. So if we're painting the walls of the storage area, chances are we're going to have to paint that more than once. So because it's more than once, we're going to put it as a revenue expense. So just place a tick. Shelving area, once it's got the shelving up, it stays up. So it forms part of the asset. The installation of the shelving is also forming part of the asset. Once it's up, we don't have to install it again. Putting the light fittings, is that a once off or is it an ongoing? So once off. And light bulbs, do you have to replace light bulbs? Yeah, you do. So that's going to be a revenue. Nice, easy. Hopefully that's 5 marks. In actual fact, it only says 3 marks. That's a bit tougher than 3 marks, better than none. Good, moving on. So just remember, capital one-off, one-off expense, revenue ongoing. Capital creates the asset. Revenue is something that we have to do often. So the last part here, we've got Ahmed, and we've got to do some calculations. Calculations are to do the rate of inventory turnover, the current ratio, and the liquid asset test. So what I encourage you to do here is to write the formula in. So the formula for for rate of inventory turnover is your COGS divided by your average inventory. Right, and the answer will be how many times does it turn over? Let's make it a little bigger so we can see. All right, got all these in the right spot. Weird. Okay, so having a look at the first one, we've got to calculate. We'll just do the other one. We've got current assets divided current liabilities. And liquid ratio is your current assets, but minus your inventory, divided by your current liabilities. All right, so let's do some workings for us. First one's the hardest because we've got to work out cost of goods sold. So cost of goods sold is going to be equal to, write these figures in because you might get points for them. It's your opening inventory plus your purchases minus your closing inventory. And all that's divided by your average inventory. So your average inventory, I always encourage you to put double brackets here, is your opening inventory plus your closing inventory divided by 2. The brackets just helps with the bed mass. In terms of that, we probably should bracket this. Right, so we've got equals open brackets. Put this in your calculator, see if you get the same answer. And because you've asked to do this to 2 decimal places, you get punished if you don't. So just take it down to 2 decimal places. And the answer is times. So basically you turn over your average inventory 8.88 times, which is probably your a month and a half, maybe just under a month and a half. So the time the inventory comes in to the time the inventory goes out takes a month and a half to turn over. Current ratio, current assets minus current liabilities. So what I do encourage you to put these up here. So we put a CA next to that. It's receivables, a current asset. Write it in. Payables is a CL. Bank overdraft, current liability. Inventory at the end is a CA. In actual fact, that one's not. That's just part of your COGS. So we've got CA, CA, CL, CL, and then the CA at the end. So what we can do, write them in here as well. 618. And if you're putting these in your calculator, we do need to put brackets in. So this tells us over the short term whether or not we've got enough money to pay our debts. So we'll go open brackets, put in the calculator, two decimal places, and the answer of that is to 1. So it means for every dollar of current liabilities, have $3.01 of current assets to cover it. So we should be able to cover our short-term debts. That makes sense, eh? You got $3.01 for every dollar of current liability, so more money than we have to pay out. Although I'll be a little bit concerned we've got a bank overdraft. So probably we need to turn some of this inventory and inventory and accounts receivable into cash to help pay for that. The liquid one is our current assets, but not including inventory. So in this one, it's actually easier than you think. So we've got our receivables, 6180, plus our cash. So it just doesn't include that closing inventory, divided by your current liabilities. And don't forget brackets. If you haven't got brackets on your calculator, just press equals. Yeah, and this one is not as good. You've only got $1.04 for every dollar of liquid liabilities. And again, most of that's because it's covered here in that closing inventory. Good, so only just got enough. So that's the end of question 4. We'll see you on question 5. Hope you managed to sort that out. Sorry, it looks like I missed the last question. Inventory turnover, because we got more stock, that's a problem. And your last question.